Hi, and welcome back to our channel. It's nice to see you again. In the last couple of years, everyone's talking about ESG investing, sustainable investing, green investing. Is it worth it? Let's talk about that. So ESG stands for environmental, social, and governance factors. And an ESG investment strategy takes those factors into account when picking investments. So, E is for environmental. It includes things like what is the carbon footprint of the companies that you're invested in? How much greenhouse gas do they emit? S is for social. That can include things like what is the diversity of the board? How are the employees treated? Are there any labor issues? And then G is for governance, and that includes things like, is the board diverse? Are the executive and the directors compensated well? Is there a good audit committee? These are the things that make up ESG, and ESG has become very popular over the last decade. There was $30 trillion of assets under management in the world that was labeled as sustainable, or ESG investing by 2021. This has grown significantly, and this is because people want to invest in companies that do good things for the world, right? You want to put your money to work in a way that is not just profitable for you, but also makes the world a better place. The problem is, until recently, those two things were seen as mutually exclusive. You had to choose between either making money or doing good. But people have figured out that you don't have to choose anymore. You can do both. You can make money and do good at the same time. But the question that we get a lot is this still true? After a couple of years, where a lot of people have lost money on their ESG investments, is it still true that you can do good and make money at the same time? A paper published in the Review of Financial Studies compared ESG funds with non-ESG funds, and what they found was that from 2014 to 2021, sustainable funds performed worse than non-sustainable funds in almost every single category across the globe. In the US, the gap was around 2% per year, and in Europe it was almost 4%. So, why is this happening? One of the reasons is that ESG funds tend to avoid certain sectors. They tend to avoid energy. They tend to avoid financials. And as you can imagine, those are exactly the sectors that did the best over the last couple of years. Another reason is that ESG funds tend to invest in companies that are more exposed to the consumer. They invest in those companies because these companies are more focused on the social aspect. And as you can imagine, consumer discretionary and consumer staples are two sectors that didn't perform very well during the pandemic and the recovery. However, if you look at it the other way, you can say that, hey, maybe this is a good time to buy those stocks that were labeled as ESG before. And maybe now is a good time to sell some of those energy stocks that did so well. Maybe it's a good time to rebalance your portfolio. Another thing to keep in mind is that there are different ways to invest in ESG. You can invest in funds that only invest in companies that meet certain ESG criteria. So, these are called exclusionary funds. There are funds that take ESG criteria into account when picking investments. So, these funds will invest in companies from all sectors, but they will pick those companies based on how strong their ESG profile is. And then, some funds try to actually improve the ESG profile of the companies that they're invested in. So, these funds engage with the companies they're invested in and try to push them to do better. So, which of these three approaches is the best one? Well, unfortunately, there is no clear answer. The academic research does not give us a clear answer. What we know is that engagement works, right? If you engage with companies and you push them to do better, they do better. However, we don't know whether that will translate into better financial performance. If I had to make a choice, I would probably go with the approach that says that you should invest in companies that have strong ESG profiles today. And the reason for that is I think that companies that are leaders in ESG today will continue to be leaders tomorrow. So, I would probably avoid funds that invest in those companies that are trying to improve their ESG profile. Yeah, because we know that they can improve it, but we don't know whether it's going to be reflected in the stock price. I would also avoid funds that exclude entire sectors, because that probably explains the underperformance. So, overall, my takeaway is that ESG investing is worth it. It may not be worth it if you're looking for the highest returns in the market, but it's definitely worth it if you're looking to make a positive impact on the world.